All right. Good morning, everybody. Happy Friday. My name is Christopher Brown with Next New Homes Group. I'm joined today with Duke Crawford from Caliber Home Loans, David Weiss from US Bank, and the infamous and famous Linda Schwartz from Tim Lewis Communities. So we've got a great conversation today. I wanted to take a quick moment just to thank our sponsors, without which this would not be possible. Home Site Services, Meritage Home Loans, Safe Credit Union, Momentum Roofing and Solar, and Wood Rogers. Thank you guys for sponsoring. We've got an awesome topic today. We're talking about interest rates and how that affects what we're going on. This is a constant conversation in all of our sales offices right now. So with that, we're going to start kind of from a macro level and get into a micro level. If you guys have questions, please put them in either the chat or the Q&A at the bottom of your screen, and we will get to those as we can. We've got a pretty packed half hour here, so we will try and get to as many questions as we can. But here we go. So guys, thank you for joining us today. I think this should be a fun conversation. Just in our pre-briefing here this morning, we had a lot of good ideas kind of floating around. So I wanted to start with kind of what's the macroeconomic pressures that are currently dictating that rise and fall of interest rates, and then how does that affect the local Sacramento market? I'll start with either David or Duke on that.
Great, thanks, Christopher. Yeah, you know, the economy has been quite a roller coaster ride for the last 6 to 9 months, and all of those macroeconomic factors are playing into that. So jobs being a big part of that. We went from having 20 million jobs unfilled and people, you know, collecting unemployment to now, or I'm sorry, 20 million unemployed, to now having, you know, 1 million jobs of, you know, unfilled jobs. So the Fed looks at things like jobs, they look at inflation, they look at all these things when they're trying to make their determination on whether they're going to increase rates or not. And Duke had a couple good points about the push and pull on that, if you want to jump in, Duke.
Yeah, sure. Well, from what I have read and see, and you know, listening to the so-called experts, in the two, well, the one big force that has caused the rise in rates is inflation, and like we all see at the gas pump and everywhere else, the Fed is out there trying to moderate inflation by raising rates. But as we go forward, and probably what's happening right now, but even though they're not calling it that yet, is we're probably in a recession. After the next quarter of GDP numbers, they'll probably be able to label it a recession. And so moving forward, I think those are two opposing forces. Inflation is going to, with inflation, the Fed is going to want to raise interest rates to moderate that. But as recession starts to raise its ugly head, then the normal reaction is to lower rates to try to bring us back out of recession. So again, those are, as I see it, two opposing forces. You have inflation on one side saying, hey, Fed, we should raise rates. But as we go into recession, will they bring them back down to try to combat that? And which one of those things is the stronger, has the stronger impact? As Christopher was saying earlier, normally that doesn't happen. Normally you don't have those two things happening at the same time, but it looks like that's where we're at, or going to be here shortly.
Yeah, I think definitely. Go ahead, David. I was going to say, definitely it's a push and pull, and the bond market is really trying to figure out, you know, which of the two beasts is going to win. And what they've been trying to do is to predict, just like markets do. They try to predict where rates will be. So that's why we've seen these huge fluctuations in rates going from, you know, the 3% range before the beginning of the year all the way up to touching 6%, and then, you know, we've backed down from there a little bit. But you know, the Fed or the bond markets have really been trying to bake in, you know, what they feel is going to happen in the markets. And a lot of experts feel that they kind of, if you use the analogy, overbake that pie a little bit. And that's why we see rates coming down a little bit now that the Fed has actually taken action, instituted their first 3/4 point increase and again, likely doing that again next week. So there's a lot of people asking me, gosh, when the Fed increases rates next week, are they going to be even worse? And, a lot of what we're seeing is no, they won't, because the anticipation of those rates going higher is already kind of set in the pricing.
Yeah, and I think that's a really good point. Especially for our salespeople and the everybody that's on the front line is we have seen a moderation of rates. We saw this just massive shift in rates over the last couple of months, and psychologically that's really hard for a consumer. But if we know that there's some stability going forward, and possibly coming back off where we are right now, and historically we're still really low. Just for everybody, for those of us who've been around for a while, these are still awesome rates. It's just we've been lulled into this expectation of these crazy low rates for so long that became normal. But I think Duke, you talked about it, is that push and pull. We are going into an unprecedented territory from an economic standpoint. Is that we have a recession that is coming, and we are now entering into that on a national level, but it is a non-housing led recession, and it is a non-jobs led recession. Those are one of the two leading causes of a recession. We are in a complete opposite of that. So like you said, David, with the bond market, they're just baking stuff in, and it's a pure guess. And I think that's why, it was nice to see this. We peaked up and then we came back down off of that. And hopefully that can bring in some normalcy, or at least some stability to the psychology of our consumer.
Yeah. And I think it's really important that, that everybody gets the message out there that this is not 2008. 2008 was a housing led recession where people were getting into loans that had zero equity, not even having to qualify. All they had to do was breathe on a glass and they would get a loan, So now we're looking at home equity. In existing home equity is at its highest level ever. Credit quality of loans is also at its highest level. Delinquencies are at all-time lows. Credit usage is down. Savings is up. And, we've got this whole job availability thing. So it's definitely not 2008. And, the customers and buyers who were out there thinking, oh, I'm just going to wait for the builders to drop their prices by $100,000 because the market's going to crash. That's not going to happen.
Right. Yeah, I think that the interesting point there is that, this is not a 2008. Everybody's most recent memory is that I'm supposed to now get a 20 to 40% discount on my house because I waited. That's what I'm supposed to get right now. And the reality is, and especially, and I use this all the time with our salespeople, is that Sacramento is in a very unique position compared to a lot of other markets, and especially on a national level, is that we are still wildly undersupplied. And we have no chance at catching up to that anytime soon, and that will continue. Now we add to it. Normally, we as home builders can make up some of that gap, and resale can make up some of that gap. Well, we as home builders can only make up so much because there's only so much out in front of us. And then the resale, what's happening, and we're seeing this a lot from our resale team, is that you have an entire swath of population that either bought or refied in the last 3 to 5 years. They are locked in at 3, maybe 4%. Why would they may need a house desperately, either up or down, but why would they put that house on the market when they have to then move to something else that is going to be at 6%? So you don't see that inventory coming out right now on top of everything. So that exacerbates our inventory issue, which puts us in a healthy, balanced state for Sacramento.
Yeah, I just read that, just under 50% of homeowners nationally have an interest rate at or below 4%. So, I mean, it's just unprecedented, like you said.
Yeah.
I would say that that's probably the biggest reason locally for this pause that we're having, right? The desire is there. The opportunity may be more available to them, but it's this push and pull of, but I'm going to be going from this rate to that rate. The little more savvy buyer is also aware that if in fact rates do come back down, and we have this conversation all the time, you can refi. That's the benefit, the beauty. With this lull, this little bit of a pause, you have an opportunity possibly to find that right home, take advantage of it. And if you believe rates are going to come down, then refi. You'll lock in what you haven't been able to do for the last year, right? As you people have been in lines and lot holds and getting behind the next person. It's a unique time. This lull is a pause because of all these things that we're talking about. You know, which way is it going to go?
Yeah, Linda, I love the word pause. We've been using that too, because we're, you know, definitely in this odd time where we have this slowdown in the market, but we also have normal summer break. This is our normal slow time.
Exactly.
And so there's our builder mentality of like, oh, the world is falling and we're freaking out, but it's also summertime. So how are you working through that with your salespeople?
Well, the challenge in that pause I talk about is that lull is exasperated right now. We talk about the fact that, you know, we need to be there to get that buyer excited, let them know this is an ideal time when the market normally slows for summer to come and choose a home, and all the things that we just talked about. You're going to see summer sales. It's part of what we do as an industry, right? To try to increase our traffic. Most of their sales are around interest rates, our topic here, because buyers don't buy a price, they buy a payment, right? It's their comfort level. We need to find a payment that they're comfortable with, not so much a price they're comfortable with. And to your point, with inventory levels so low, it shouldn't fuel that reduction in sales prices this time around. Everybody spoke to the fact that, you know, Dave knows that I'm a real follower of consumer confidence. Certainly inflation is putting some pressure on that, but we're also seeing, you know, hopefully a trend where gas prices are starting to come down. Love to see that continue. But they are in this watch and wait mode. And so we really have to help them see this as an opportunity and not miss that window.
Yeah, and it's Warren Buffett always says the best time to invest is when everybody else is fearful, right? So
right. That's a hard thing to do though for people, but yes, absolutely.
Yeah, it's definitely interesting. This pause, everybody's waiting, everybody's on the fence, everybody's just trying to see what happens next and trying to, you know, we've lost urgency in the market. And so now our salespeople have to get back from where they were just 6 months ago, where, oh, you don't qualify, next. And now it's, somebody had a great meme of, they had two different people. They had like the worst customer service image that you could possibly see. And then they had Chick-fil-A, and we went from, you know, oh, you know, if you're not interested, fine, you know, next. And now we went from Chick-fil-A, how may I help you? You know, and we've really had that dynamic shift in the last couple of months. So it's a good thing because now we get better at sales, but how do we break through that pause? And we still have a need to sell the inventory of what we already have under construction. So, you know, as we've talked about, and I think we've seen this for most builders in the market right now, everybody's advertising either a buy down or 2-1 or, you know, any of those kind of things right now. How is, Linda, what are you seeing the consumer connecting with from a messaging standpoint? What's making them move?
Well, I think it's a little bit of everything. You know, we have two different markets. Most of us as builders have our first timers, and we of course have some higher end, very much so higher end homes, which takes hand holding. The equity that higher end buyer has established through this market is huge, right? And so they have more ability. Their down payments are greater, and quite honestly, the jumbo rates are still really favorable, right? They always are more attractive. Well, I shouldn't say always, but they certainly are now, and normally more attractive than conforming, because that buyer is better qualified to buy a home. There's less risk for the lender. So we have two markets. It's really the entry level that we're having to focus on, educate, and help in that payment process. For those who have been waiting for a year for a home, they're the ones who are having the hardest time. They got pre-qualified to get on a list, and now we're updating those pre-quals. They may not qualify anymore. So their choice is either to take a bought down rate so we can get them closer to the payment that they're used to. And 2-1s, while available, are really a short time fix. When we look at longevity, how long a buyer stays in a home, we really try to focus on that 10-1 rate, right? What can we do to get them into a fixed rate for 10 years where they're comfortable? Again, we talked about it. If rates come down, refi out of it. Get into that 30-year fix, as that's where your comfort level is. So it's really just, you've got to gear it to where their comfort level is and where you can actually get them into a home, because many of them, based on what they thought they were going to qualify for, are no longer in that price point. And I think Dave or Duke can speak to what's happened in this increase as far as affordability and how that payment has changed.
Yeah, we were talking about it a little bit earlier, and I ran some numbers yesterday leading into this call, and so the difference between in a payment between so I ran it off of what our average loan amount is, which is $560,000. The difference between a 5.5% rate versus a 4.5% rate is $343 a month, and that equates to about $60,000 in purchasing power. So like Linda was saying, that buyer that may have shown interest last year that is now looking at it again, what they could have qualified for last year is not the same as what they could qualify for this year, all other things being equal.
Yeah, I think that's really interesting right now. And we've been talking a lot about, from an advertising standpoint, as you market things, marketing, rate is one thing, but marketing payment is a different. And I think the payment connects better with the consumer. And, Duke or David, you guys can talk about this a little bit more than we can, but I think the biggest challenge that we have is we want to advertise something that connects with the consumer and helps get them off the fence. But if we advertise a rate, then my ad's this big and my disclosure is this big, and then trying to advertise even a payment gets even more cumbersome, because then the disclosure is this big. And so, the things that you try and do right by the consumer end up becoming more cumbersome to really connect with the consumer. So, can you guys talk about that a little bit?
Yeah, I mean, it's definitely a challenge to try to, and Linda and I have talked about this a number of times too, trying to advertise a rate, because, we're still in such a dynamic and volatile market, and lenders, for the most part, aren't putting out forward commitments and things because they don't want to commit to a rate either. So really what it comes down to is really trying to find, as Linda said, the buyer to find that home that fits them, and then try to work the payment into that. So looking at different options, like not just looking at a 30-year fixed, or looking at permanent buy downs or temporary buy downs that help them get into that with a more affordable payment. There's a question in the chat, is a 40-year mortgage coming back? And there's always talk about 40-year mortgages, and it just doesn't seem like there's the appetite out there. They always will bring it up. Fannie and Freddie, continues to say, oh yeah, we'll look at it, but it's still not a favorable product out there in the market. So I don't anticipate seeing one, at least at this point. And I also don't anticipate seeing lenders going to things like they did before, where it's, stated income and, 100% financing, things like that. We did that once, didn't work out so well. I don't think we're going to go down that path again.
Yeah, Duke, I think it's funny that, you and I started the year talking about forward commitments and, getting everything teed up to have, what can we buy rates for the first, quarter of the year, and we'll just, do a big forward commitment to is shifting rapidly to, okay, how much can we spend on a permanent buy down? It's funny how that just rapidly went from one to the other.
Oh yeah, I mean, you look at the difference in what we were talking about in January versus what we're talking about now.
Yeah,
it's incredible.
So
how quickly it's happened.
Oh, absolutely. So I think, as we're down to about 7 minutes left here. I really want to kind of get into what do you guys, from a rate standpoint, and we'll talk a little bit about what are you guys seeing, what are you guys expecting over the next 6 to 12 months, and then Linda, you and I will finish off on how do we connect with today's consumer and to really kind of figure out where we are and where we're going. So Duke and David, let's give you a couple minutes on what are you guys seeing, what's currently baked in, as we talked about earlier, and then where do we go from here? Duke, you want to start?
Yeah, I would echo what David was saying earlier. I think a lot of the economic news that we have right now, or what is coming out with the Fed next week, is already baked into our current rates. Again, I call them the so-called experts because half the time they're right and half the time they're wrong. But the so-called experts in our industry, guys like Barry Habib, who does interest rate forecasting, the talk in our industry is that they're predicting rates to come back down in the next 6 to 9 months. They're thinking that when these recession numbers really start to hit, and we start to be able to actually see it, which recession is over 2 quarters. So we're not technically in a recession right now, but everybody's predicting that when the next quarter's numbers come out, that we will be, that will start to lead the Fed to dropping rates again. And by the time all that, comes to fruition, we're probably looking at the beginning of next year to the spring of next year, rates dropping. Again, I say that very tentatively because some of these same guys last fall were saying that rates would cap out in the mid 4s this year. So they were obviously wrong, right? So, but that is the what I'm reading by the so-called industry experts.
Yeah, and one of the things I like to do is go back historically to look at where rates were. The last time the 10-year Treasury was above 3%. So November of 2018 is one of those benchmarks where, not in a volatile market, we were just at that range for the 10-year Treasury, and interest rates for a conforming 30-year fixed agency product were, right around 4.875, and jumbos were, slightly below that, around 4.5. So looking at that, that's kind of what I would like to use to say, hey, historically, when we were at 3% on the 10-year Treasury, this is where rates were. There's been a little too much enthusiasm and guessing in the bond market, and things should level back down from here. And that's one of the reasons, we're telling people, right now, you should, if you're in contract on a home or you're going into contract on a home, one of the most important things you should do is lock in your interest rate with a long-term lock. There's products out there where you can lock that in. And then the great news is, if interest rates do come down in 6-9 months when the home's ready, then you get to float down to that lower rate. And it's really an insurance policy. That's how I like to sell it. We're guaranteeing you this rate today, but there's a good chance or a chance that if rates come down during the next 6 to 9 months, you'll get to drop down to this low.
Yeah, because we're low on time. I don't know if you're okay with this, Chris, but we have a couple questions that I think are pertinent to our market.
And you win both ways. So
yeah, go for it, Linda.
One of the questions is, what percentage of Bay Area buyers are still moving to Sacramento? I will tell you that traffic numbers from the Bay are down, but we're also summer 100-degree weather, which is not the best weather to go take a drive and look at homes. That, coupled with the fact that the local equity is so high, we are much less dependent on the Bay Area market than we used to be. We still follow their trends. If something major happens there, it rolls to us in usually the next quarter. But we have become independent to some degree of the Bay Area. They still fuel our market by coming with fistfuls of cash, especially on the resale side. Anyone who's looked for a new move-up home and gotten caught in that, you know, found that cash is king, and most of that does come from the Bay on the resale side. And then secondly, has the stock market loss affected buyers with who needed combined assets to qualify? I will tell you, we have not seen a lot of that, and I will, you know, defer to Dave, who does a lot of our loans, and Duke, I'm sure, experiences too. But most of our buyers are not looking to pull from the stock market in order to qualify. So I don't think, you know, that has been more of a long-term savings for the buyers, not their immediate cash or equity that they were going to use to purchase a home.
Yeah, one of the things we've seen is people who were previously going to go all cash have now decided maybe I should go do a loan instead, so I don't have to pull out
a little more in the bank, huh?
Yep.
Yeah.
And I would say I've seen that happen twice in the last 6 months, and that's been with very high-end buying, you know, people buying up in the $2 million, $2.5 million range. That might limit them, the stock market drop. And I've seen it, like I said, in 6 months, I've seen it happen twice. I don't think it's across the board.
Well, guys, as we wrap up, this was a great conversation. I think in summary, we're in a somewhat stable market for rates, not really seeing a lot of upward pressure in rates, possibly some downward pressure as we go into a recession. Recession is always that fear word, with fear of loss, fear of making a bad decision, but that might actually be a positive as our salespeople discuss this with the consumer, is that recession is actually going to help them qualify for more home if it puts downward pressure on our rate. So that's a good thing going into this, you know, recession. Recession has always been this bad perception, but that could be a good thing for housing this time around. And we're in this summer lull. So we all got to remember that, you know, we're all nervous that buyers are not there right now and the traffic's really low and the sales are really low, but we're also in the summer lull. And we also had a consumer that just went from 3 to 6%. Well, we got to mentally get them through that. And as we enter into fall and people naturally come back to the market, people have naturally gotten used to the new rates, and we get some downward pressure on rates potentially, we're in a good spot. And by the way, Sacramento is still wildly, wildly undersupplied. So I think overall, we're in a good spot. We just have to get back to actually selling and selling what the consumer wants and how they want it done. So I think that's, you know, really where we go. So real quick, just want to say a quick thank you to all of our sponsors: Home Site Services, Meritage Home Loans, Safe Credit Union, Momentum Roofing and Solar, and of course, Wood Rogers. Thank you to my panelists, Duke, David, Linda, you guys are awesome as always. I really appreciate it. My name is Christopher Brown with Next New Homes Group. Thanks for being here, and we'll see you at the next one.
Thanks.